Viewers at home, you are welcome to my presentation on IAS 7 statement of cash flows using direct method. This is an extension of my presentation on IAS 7 under direct method. In this presentation, I want to provide a comprehensive work example to explain my earlier principles. If this is your first time of coming across my channel, or if you have not subscribed in the past, please hit the red subscribe button and turn on the notification bell icon so that you'll be notified each time I drop a new video. If you are a returning subscriber, I say thank you and God bless you. IAS 7 statement of cash flows. This question is obtained from Kaplan ACCA study test. ACCA study test by Kaplan. The following financial statements relate to BT for the year ended 31st May 20x7. You are given statement of financial position as at 31st May 20x7 and 20x6 respectively. The first item is non-current assets. Under the non-current assets, we have property, plant and equipment. 20x7 we have 572 and 496 for 20x6. Intangible assets. For 20x7 we have 30 and 20x6 40. The total of non-current assets is 602 and 536 for 20x7 and 20x6 respectively. Then we have current assets. We have inventory 140 and 155. Receivables 130 and 110. We have investments 95 for 20x7 and 20 for 20x6. We have cash at bank. We have 7 for 20x7 and 3 for 20x6. We have total current assets 372 and 288 for 20x7 and 20x6 respectively. Total assets 974 and 824. 974 and 824. Then we have equity. $1 equity shares. 20x7 we have 230 and 200 for 20x6. Share premium 45 for 20x7 and 35 for 20x6. Then revaluation reserve 22 for 20x7 and 12 for 20x6. Retained earnings 166 for 20x7 and 147 for 20x6. Total equity we have 463 and 394 for 20x7 and 20x6 respectively. Then we have non-current liabilities, which include lease liability 49 for 20x7 and 30 for 20x6. We have loans 31 for 20x7 and 60 for 20x6. Then government grants 80 for 20x7 and 75 for 20x6. Deferred tax 72 for 20x7 and 67 for 20x6. Then warranty provision 30 for 20x7 and 26 for 20x6. We have total non-current liabilities 262 for 20x7 and 258 for 20x6. Then we have current liabilities, which include bank overdraft 8 and 20 for 20x7 and 20x6 respectively. Trade payables 210 for 20x7 and 111 for 20x6. Lease liabilities 5 for 20x7 and 3 for 20x6. Income tax 20x7 we have 14 and 10 for 20x6. Interest payables we have 2 for 20x7 and 8 for 20x6. Then we have government grants 10 for 20x7 and 20 for 20x6. Then total current liabilities 249 and 172 for 20x7 and 20x6 respectively. Then total equity and liabilities 20x7 we have 974 and 824 for 20x6. Then we have statement of profit or loss for the year ended 31st May 20x7. All amounts are in $1 million. The first item is revenue. We have 312. Then cost of sales, we have 187. Gross profit, we have 125. Distribution cost, 31. Administrative expenses, we have 27. Finance cost, we have 17. Investment income, 3. Profit before tax, 53. Then taxation, 22. Then we have profit for the year, 31. Then we have movement on retained earnings reserve, RE, that is retained earnings. Movement in retained earnings reserve. Retained earnings reserve brought forward, we have 147. Then we have profit for the year of 31 and dividends of 12. Then retained earnings carried forward, we have 166. Then we have notes. The first note, we have property, plant and equipment. During the year, assets with a book value of $31 million were sold for $21 million. New assets acquired under leases totaled $28 million. Depreciation charge for the year totaled $37 million. The second note is government grant. Grant income of $55 million has been credited to operating expenses during the year. Then the third note is intangible assets. There were no movement during the year except for amortization. Then the next note is current asset investment. The current asset investment is an investment in 30-day government bonds. The current asset investment is an investment in 30-day government bonds. Then the next note is warranty provision. The warranty provision relates to costs that are expected to be incurred in repairing faulty goods that have been sold with a warranty. The provision is charged to cost of sales. Then the next note is shares. On 1st September 20x6, a 1-for-20 bonus issue was made utilizing share premium. A 1-for-20 bonus issue was made utilizing share premium. On 1st February 20x7, a further share issue was made for cash required. Prepare a cash flow statement for BT for the year ended 31st May 20x7 in compliance with IAS 7. In compliance with IAS 7. The name of the entity is BT. The name of the company is BT. And you want to prepare statement of cash flows for the year ended 31st May 20x7. Now, in compliance with IAS 7. Remember, IAS 7 recommends two methods of preparing statement of cash flows. IAS 7 recommends two methods of preparing statement of cash flows. We have direct method and indirect method. Those are the two methods. But for our purpose in this lecture, we are going to solve the question using the direct method. So, solution. So, we have BT. That is the name of the entity. Then we want to prepare statement of cash flows for the year ended May 31st, 20x7. So we want to use direct method. We want to use direct method of preparing statement of cash flows. Remember, all amounts or figures involved are in $1 million. So now let me have notes. The first heading is operating activities. Operating activities. Remember, I've told you that if you have watched my earlier presentation, I've told you that operating activities are activities that occur within the normal business cycle. Activity that falls within the normal business, that is, that arise in the normal course of business. Cash flows under this include cash received from customers. Cash received from customers. Let's have that as note 1. Then the transaction that have to do with customers that you can find in your financial statement include receivables. Receivables will be found under current assets. I've told you that we used to have opening balance and closing balance. For our purpose, we used to start with opening balance in our workings. So we always start with the opening balance. So receivables, cash received from customers. So then you have receivables in current assets. Then we have revenue in the statement of profit or loss. Then you may have discount allowed or bad debts in the notes to the financial statements. Don't forget, I've told you that the minimum requirements for the preparation of statements of cash flows are 1 statement of profit or loss and other comprehensive income, 2 statements of financial position, 3 we have notes to the financial statements. Now we want to calculate the amount of cash received from customers. Let's have that as working 1. We want to calculate the amount of cash received from customers. I've told you that we used to start with the opening balance, the opening receivable balance, the opening balance of receivable. That is the first item to start with. We have opening balance. Opening balance. That is opening balance of receivable. Receivable. Then after that, I've told you that this will be found in the opening statement of financial position. After this, you have revenue. Revenue will be found in the statement of profit or loss. I've told you that the first item should be the opening balance. The opening balance will be found in the opening statement of financial position, then followed by revenue, which will be found in the statement of profit or loss. Then you have closing balance, which will be found in the closing statement of financial position. That is the closing balance. We are still talking about receivable. I've told you that your receivables will be found under current assets in the statement of financial position. Now let's check our current assets. Our statement of financial position, we have receivables 20x7. This is 20x7 and this is 20x6. The opening balance is 20x6 while 20x7 is the closing balance. So that means the opening balance is 110 while the closing balance is 130. So we are going to slot it in. So the opening balance, we have 110 while the closing balance is 130. We used to subtract our closing balance. Then your revenue will be found in the statement of profit or loss. Our revenue is 312. So you are going to slot in our revenue 312. 312. So that means we have opening balance plus revenue minus the closing balance. That will give you the cash received from customer. Then the difference is 392. 392. This 392 is the amount of cash received from customer. Then we are going to slot it in. So in our statement of cash flows, the cash received from customer is 292. That is operating activity. Then the next thing is cash paid to suppliers. Cash paid to suppliers. That is note 2. Cash paid to suppliers. Cash paid to suppliers. Cash paid to suppliers. Then the transaction that have to do with the suppliers, you will find in the financial statement is number one, the payables. Your opening balance of payables will be found in the opening statement of financial position, while the closing balance will be found in the closing statement of financial position. Then after payable, then the next thing is purchases. But since you'll be given the published financial statement, the purchases, the credit purchase will not be given, but you will only see the cost of sales. Your purchases is part of cost of sales. Don't forget. Remember to calculate your cost of sales. You used to have opening inventory plus purchases minus closing inventory. That will give us cost of sales. Then if you make your cost of sales the subject, the purchases the subject, now your purchases will be equal to cost of sales. Then when you take this closing inventory to go and join it, to go and join cost of sales at the right hand side, the minus become plus. You have plus closing inventory, then minus, this is plus. When it goes to the right hand side, the plus become minus, minus opening inventory. That means our purchases will be equal to cost of sales plus closing inventory minus the opening inventory. Don't forget, we used to start with our opening balance. The opening balance you are going to start with now is the opening balance of payable. Opening balance, that is payables. I've told you that your payables will be found under current liability in the statement of financial position. How much is our trade payable? Under current liabilities, we have trade payables 210 for 20S7 and 111 for 20S8. 20S6, I mean. The 111 for 20S6 is the opening balance. That means the opening balance of payable is 111. Then, after the opening balance, you add purchases. You add purchases. But your purchases will not be given. Then that means you will need to look for purchases. I've told you that to get your purchases, you have cost of sales. Now, let's write our cost of sales now. Cost of sales. Our cost of sales. How much is cost of sales? Your cost of sales will be found in the statement of profit or loss. Our cost of sales is 187. So that means we slot in the 187 as our cost of sales. 187. After that, we said cost of sales. Cost of sales has been considered plus closing inventory. So we want to add closing inventory. Our closing inventory will be found in 20X7 statement of financial position under current assets. So the closing inventory now, inventory 20X7 140 and 20X6 155. This is closing and this is the opening. So we now have plus the closing inventory of 140 minus the opening inventory minus opening inventory. So we let the opening inventory. Our opening inventory is 155. So when you less that is 187 plus 140 minus 155, then we have 172. This 172 ought to be our purchases if no unusual item have been charged, that is, if no non-inventory item is charged to cost of sales. But where the non-inventory item have been charged to cost of sales, then that means the 172 cannot be our purchases. Now let's check the note to know if there are items that are non-inventory that have been charged to cost of sales. Depreciation. During the year, assets with book value of 31 million were sold for 21 million. New assets acquired under leases totaled 28 million. Depreciation is charged for the year total 37 million. You have not been told that depreciation is charged to cost of sales. So we still want to assume that the depreciation will be charged to administrative expenses, since you have not been told that they have been charged to cost of sales. The next note, Grant income of 55 million has been credited to operating expenses during the year. The grant income has been credited to operating expenses, so it does not affect the cost of sales. Then intangible non-current asset. There were no movement during the year except for amortization charges. So the amortization too, since depreciation was not charged to cost of sales, that means amortization will not equally be charged to cost of sales. Then the next item is current asset investment. The current asset investment is an investment in 30-day government bonds. You were not told that it had been charged to cost of sales. So the next item is warranty provision. The warranty provision relates to costs that are expected to be incurred in repairing faulty goods that are being sold with warranty. The provision is charged to cost of sales. You have been told that the warranty provision that has been charged to cost of sales. Since this has been charged to cost of sales, then you will need to eliminate it because it is the warranty provision is not an inventory. So since it is not inventory item and it has been charged to cost of sales, its effect will be eliminated from our cost of sales to get our inventory. How much is the warranty provision? Then you check your statement of financial position where you have warranty provision. Now we have under non-current liability. You were told provision, warranty provision 30 in 20x7 and 26 in 20x6. That means warranty provision increases by 4 million. It increases from 26 million to 30 million. Increase now, which have been charged to cost of sales. That means it has been treated as an expense. It has been added to cost of sales. So you are going to eliminate it from cost of sales. The effect of warranty provision, so that our purchase now will be those ones that relates to inventory. So warranty increase in warranty provision, which is $30 million minus $26 million. The difference is $30 million minus $26 million. The difference is 4 million. So if you remove that 4 million from cost of sales now, the inventory, the purchases now, our purchases now will be 168. That is our purchases. So if your purchases is 168, if you add it to 111, that is the opening balance of payable, then your purchases, you will now be having the balance of 279. Then you'll be having the balance of 279. Then from that 279, you less the closing balance of payable. You less the closing balance of payable. The closing balance of trade payables is 210. You know the opening balance is 111, while the closing balance is 210. So we less the closing balance. So if we subtract the 210, so the remaining balance will be the amount of cash paid to suppliers. Closing balance, that is payables, which is 210. If you remove 210 from 279, if you remove 210 from 279, the difference will be 69. That 69 is the amount of cash paid to suppliers. Cash paid to suppliers, and the cash paid to suppliers is an outflows. The cash paid to suppliers is an outflows, so you are going to subtract it. So we have 69. After cash paid to suppliers, the next is other cash expense. Other cash expense. Other cash expense. Let's have that to be note 3. Other cash expense, note 3. I've told you that the items that will fall under this heading, working 3, other cash expense. I've told you that you are going to have distribution expenses and administrative expenses. So distribution cost and administrative expenses. Remember, these items have been reported in our statement of profit or loss, and the statement of profit or loss have been prepared in line with accrual basis. The distribution cost is 31, administrative expenses is 27. So now let's load them in. Distribution cost 31, administrative expenses 27. The statement of profit or loss have been prepared in line with accrual basis. Those items that have been recognized in accordance with the accrual basis have to be eliminated. Accrual basis used to recognize depreciation. Where depreciation have been included in these expenses, then you will need to eliminate that depreciation. Now let's go through the notes one after the other. So then we have the first note is on property, plant and equipment. During the year, asset with a book value, remember book value, that is the carrying amount, which is cost less accumulated depreciation. Book value of 31 million were sold for 21 million. That means there is a disposal of an asset. The carrying amount is 31 million and the proceed is 21 million. This asset has been sold at a loss of 10 million. That is the difference between the carrying amount and the proceed. So new assets acquired under leases totaled 28 million. This is an asset acquired on lease. Depreciation charge for the year totaled 37 million. That means the depreciation will have been included in administrative expenses. So you are going to eliminate its effect from that because you want to convert from accrual to cash. You know, depreciation have been included in administrative expenses. We want to eliminate it. The loss on disposal, which is 10 million, the difference between 31 million and 21 million, also will have been included in administrative expenses. So on the basis of the depreciation policy, since depreciation policy is on administrative expenses and not on cost of sales, so that means depreciation will have been added to administrative expenses. So the depreciation now, which have been added, so we are going to eliminate that. The depreciation is 37 million, so we eliminate it. Then loss from disposal of PPE, loss from disposal of PPE, which is the difference between the carrying amount. The carrying amount of the PPE disposed is 31 million and the proceed is 21 million. That means there is a loss of 10 million. So that will also be eliminated. Then the next note, after the PPE, the next note is government grant. You were told grant income of 51 million has been credited to operating expenses during the year. Operating expenses is your administrative or distribution expenses. So since it has been credited, that means it has been subtracted from the operating expenses. Since it is an income, grant income, it has been subtracted, it has been deducted from the operating expenses. So you are going to add it since the operating expenses have been reduced. So we have grant income which has been credited, so you add it back. So in order to bring that operating expenses, because the grant income follows the accrual basis or accrual based principle. Then the next thing is intangible non-current assets. There were no movement during the year except for amortization. How much is the amortization? Amortization also follow the same principles with the depreciation, the same basis. Since depreciation has been charged to administrative expenses, that means amortization too will have been charged as part of administrative expenses. So intangible asset now, the one for 20x7 is 30 and 20x6 will have 40. That means amortization of 10 has been charged. Amortization is just like depreciation. Just that only that amortization is depreciation charge on assets of a legal life. So amortization of intangible asset now, amortization. So which is different between the 40 million and 30 million. So we have 10 million. So we are going to remove it since we have removed the depreciation. So aside that, there is no accruals or prepayment. In case you have other payables as part of current liabilities, if you have other payables, know that other payable means accruals. We have trade payables, we have been used in calculating our purchases. Then we have interest payable. This relates to interest. But if you have other payables, you know that it is accrued expenses, then you are going to eliminate the effect of that accruals from the expenses. Now, after this adjustment, 31 plus 27 minus 37 minus 10 plus 55 minus 10, then you will be left with 56. 56. That is the other operating cash expense. Other operating cash expense. That is the amount you are going to recognize. So as operating activity. So which is 56. So it is an outflow because it is paid. So we subtract that. So after this, then you have 292 minus 69 minus 56. Then you have 167. After that, we have interest paid. Interest paid. Let's have that as note 4. Interest paid. I've told you that to calculate your interest paid, then you start with the opening balance of interest payable. Then you add the finance cost. The finance cost is in the statement of profit or loss. And our finance cost is 17. Finance cost 17. That means you start with the opening balance, that is your interest payable, which is 20 plus that finance cost minus the closing balance of 10. So that will give you the amount of interest paid during the year. Then we have note 4. Note 4, which is interest paid. Then you start with opening balance, which is interest payable. I've told you that this is found under current liability in the statement of financial position. We have 8 million. Then you have the finance cost, which is charged in the statement of profit or loss. Finance cost of 17. Then you now less the closing balance. Closing balance, which is interest payable under the current liability in the statement of financial position, and that is 2. So now after this adjustment, then you have the amount of interest paid during the year, which will be 23. So you report that as operating activity, which is 23. Outflow, since it is payment, it is an outflow. Then the next thing is taxes paid. Taxes paid. Let's have that as note 5. Taxes paid. I've told you that tax information will be obtained in the statement of financial position under current liability. Then at the same time, it will be obtained under current. It will be obtained under non-current liability. That means information about taxes will be obtained under both current and non-current liability in the statement of financial position. Then you are starting with the opening balances as usual. So you want to calculate taxes paid. We have opening balance. Opening balance, that is your tax liability. I've told you that you have some information, tax information under current liability. Under current liability, you have income tax. You want under current liability. Under non-current, you have deferred tax. Then in your statement of profit or loss, you may also have tax expense or income tax expense. Tax expense, the amount of tax that was expensed in the statement of profit or loss. Now let's look for those figures. Then under current liability, you have income tax The opening balance is 10, while the closing balance is 14. So opening balance 10. Then under non-current liability, then you have deferred tax. Deferred tax under non-current liability. The opening balance of deferred tax is 67, while closing balance is 72. So we are starting with the opening balance. No, under current liability, you have opening balance of 10. That is your income tax. You have 10. So now let's start with that. The opening balance income tax is 10. Then the deferred tax, the opening balance under non-current liability is 67. Then in our statement of profit or loss, we have tax expense, that is taxation of 22. Taxation of 22 in the statement of profit or loss. Now let's put it 22. Then you now less the closing balances. You now less the closing balances. That is your tax liability, which will include income tax under current liability and deferred tax under non-current liability. How much is the amount? So under current liability, our income tax, the closing balance is 14. Then under non-current liability, deferred tax closing balance is 72. Now let's consider those two balances now. The closing balance under current liability, our income tax is 14. While deferred tax under non-current liability, the closing balance is 72. After this adjustment, you have the amount of tax paid, and that will give us 13. That is the tax paid, 13. That is 10 plus 67 plus 22. 10 plus 67 plus 22 minus 14 minus 72. That will give us 13. That is the taxes paid during the year, which is 13. Now let's slot in that 13. So it is part of our operating activity. So 13 is an outflow because it is a payment. Now you now have 167 minus 23 minus 13. Then you have the difference of 131. 131. That 131 is the net cash flows. Net cash flows from operating activity. Net cash flows from operating activity. After operating activity, the next heading will be investing activity. Investing activity. I've told you that these are activities that result in changes in non-current assets and investment. I've told you that the moment you get to this investing activity, you are going to check the movement in non-current assets. Let's have that as working 6. Working 6. Movement in non-current assets. The non-current assets include property, plant, and equipment. PPE, that is property, plant, and equipment. Movement in PPE. Now, let's check the PPE. So we are starting with the opening balance as usual. Our property, plant, and equipment. The opening balance is 496. 496. So you start with the opening balance, which is 496. Opening balance, that is PPE, which is 496. Now let's go through the note on PPE. What are those information that will affect PPE? I've told you that information such as depreciation will lead to reduction, acquisition will lead to increase, disposal will lead to reduction. So now let's look at that. During the year, assets with a book value of 31 million were sold. There is a disposal. This 31 million, the carrying amount, that is the book value, you are going to remove that. So that will lead to reduction in PPE. Were sold for 21 million. You don't need the proceed in the movement in PPE. You don't need the proceed. New asset acquired under lease totaled 28 million. Another one, there is an acquisition under lease, and depreciation charge for the year totaled 37 million. That means you are going to consider depreciation, you are going to consider asset acquired through lease, and you are going to consider the carrying amount of the asset disposed. Now let's incorporate those adjustments now in our movement in PPE. So we have disposal. There is a disposal. I've told you that it is the carrying amount of the PPE disposed that will be considered. But in case you are given the cost and the accumulated depreciation attributable to the PPE disposed, then you subtract the accumulated depreciation on the one disposed from the cost in order to get the carrying amount. So we have 31 million. The carrying amount is given. I've told you that carrying amount is cost less accumulated depreciation. Lease asset. Another one was acquired through lease, and that is 28 million. Then we have depreciation charge for the year. Depreciation will lead to reduction in PPE. Depreciation of 37 million. Since it will lead to reduction, we are subtracting it. Then go through the equity section of your statement of financial position. Under equity, you have revaluation reserve. Revaluation reserve, the one in 2006 is 12, and it's now increased from 12 to 22 in 2007. That means additional revaluation gain of 10 million has been created during the year. So there is a revaluation gain because the revaluation reserve increases from 12 million to 22 million. So that means revaluation gain of 10 million has been created during the year. So we have revaluation gain. So I've told you that where there is revaluation gain, PP increase. Revaluation gain. It increases from 12 million to 22 million. So that means gain of 10 million. Now, after this adjustment, so if you have 496 minus 31 plus 28 minus 37 plus 10, then that will give us 466. 466. From this 466, you let the closing balance of PPE, closing balance, that is that of PPE. How much is the PPE in the closing statement of financial position? I've told you that the closing statement of financial position is the statement of financial position for 20x7, and the PPE balance is 572. So now let's subtract the 572 in order to get 572. So if you look at the closing balance, it exceeds this 466. That means more PPE have been acquired, that is more PPE have been bought during the year, and that is 106. That is 466 minus 572. That will give us 106. That means we have purchases of PPE, or property, plant and equipment. That is note 6. So we have note 6, and that is 106. When you purchase, you pay out cash. Then remember, there is a disposal of PPE, proceed from disposal of PPE, and that is given to be 21 million. The proceed from disposal of PPE, that is, when PPE is disposed, more cash will be received. So the PPE, that is, were sold for 21 million. During the year, asset with book value of $31 million were sold for 21 million. So that means that 21 million is the proceed. So when a PP is sold, more cash will be received. That means the cash position of the entity will increase. So that is why we are treating that 21 million as an inflow. If you look at the non-current asset, aside PP, we have intangible assets. We were told that the only movement in intangible assets is the amortization charges. So that is why we have recognized the amortization of 10 million, which is the difference between 14 and 30. So that means there is no purchase of PP, no purchase of intangible assets during the year. So then we move on. The next note is government grant. Grant income of 55 million has been credited to operating expenses during the year. Then you will need to calculate the amount of grant received. How much has been received? Remember, you were only told that the income of 55 million has been credited to the statement to operating expenses. So grant received. You know, the grant income will be recognized in line with the accrual basis of account, but the amount received will be calculated, will be recognized on cash basis. Remember, I've told you that the statement of cash flows is prepared in line with the cash basis of account. So, but your statement of profit or loss and statement of financial position, that is prepared in line with accrual basis. So you want to convert from the accrual based financial statement to cash based financial statement. That is what we are trying to do here. So working 7. So we now have grant received. The grant received. You know, grant is an income. So we now have grant income, which have been credited to operating expenses of 55 million. Grant income of 55 million. If you go through your current liability, you will see grant there. In your current liability, government grant, the opening is 20 and closing, while the closing is 10. The opening is 20, the closing is 10. So you are going to add the closing. You add the closing, you are going to less the opening because grant. So you add the closing, you less the opening. So the closing is 10. Then we want to add that 10. Then check your non-current liability as well. You have government grant. Government grant, the closing is 80 while opening is 75. So you will also add the closing. That means we want to add the two closing balances. The one we have under non-current liability, which is 10, and the one we have under the current liability, which is 80. So we add closing balance. Closing balance, that is grant liability. Closing balance, that is grant liability. Then we have the one under current liability, and the one under non-current liability. The one under current liability, the closing balance is 10. While the one under non-current liability, the closing balance is 80. So 55 plus 10 plus 80, that will give us 145. Then you less the closing balance, you less the opening balances. You less the opening balances. That is your grant liability. The one under current liability, the opening balance, the one under current liability, government grant, is 20. The one under non-current liability, and that is the one under non-current liability, the closing balance is, the opening balance is 75. 75. The opening balance. So if you have 20 plus 75, that will give us 95. If you subtract 95 from 145, then the grant received will be 50. So this will be recognized as investing activity. So grant received of 50 is an inflows. So if you don't want to use the statement format, you may also use the T format like this. So you open grant account, you open government grant account, government grant account. This is the debit side and this is the credit side. You know, these are the opening balance and they are both liability, balance brought forward. The one under current liability is 20. Liability will have a credit balance. That's why I'm putting the opening balance at the credit side. The one under non-current liability, and that is 75. This balance. Then we have grant income of 55. Remember, income will be credited to statement of profit or loss. If you credit statement of profit or loss, statement of profit or loss, grant income of 55, then the closing balance will be balance carried down, the one under current liability and the one under non-current liability. The one under current liability, the closing balance under current liability is 10 and the one under non-current liability is 80. So we have current liability 10, non-current 80. When you sum up this, the total of the debit side, 55 plus 10 plus 80, we have 145. The credit side, 20 plus 75, that will be 95. If you subtract 95 from 145, then you have bank or cash. The difference, 145 minus 95, that will give us 50. That is the amount of grant received. Total is 145. The closing balance will be brought down here. Balance brought down. Current liability of 10. Non-current liability of 80. So I'm managing that space. So this grant received of 50, which is the difference between the two sides, is what are recognized as investing activity. Then, aside this, you check your statement of profit or loss. We have investment income. Investment income, which is 3. Then, if you check your current asset, there is no investment income receivable. We have investment. Investment is different from investment income receivables. And receivables is different from investment income receivables. If you have investment income receivables, that means the investment income due not yet received. Then that will be adjusted. But since there is no investment income receivable, that means the investment income of 3 has been received during the year. So you are going to have investment income received. Investment income received, which is 3 million. Then after this adjustment, Then minus 106 plus 21 plus 50 plus 3. Then you have minus 32. That minus 32 is the net cash flows from investing activity, which is minus 32. Then after investing activity, the next section will be financing activity. I've told you that whenever you get to this section of the statement of cash flows, the first thing you should do is to check the movement in equity. Working 8. Movement in equity shares. So you start with the opening balance. As usual. Your opening balance in equity shares. And share premium. Opening balance in equity share and opening balance in share premium. The two will be brought together. Now let's go through the equity section of the statement of financial position. Then equity shares, the opening balance is 200 and the opening balance of share premium is 35. So now let's bring the two into our working. 200 and 35. Now let's go through our notes. Now let's go through the note on shares. On 1st of September 2006, a 1-for-20 bonus issue was made utilizing share premium. I've told you that whenever a bonus issue is made from share premium, no adjustment is required. On 1st of February 2007, a further share issue was made for cash. You ignore the information about bonus issue since it was made from share premium. Now, the closing balances now of equity share. Now you have the share capital of 230 and share premium of 45. Now let's consider the closing balance. This is total 235. Closing balances that of equity share. The equity share closing balance is 230 and the share premium is 45. When you sum it up, you have 275. If you subtract 275 from 235, then you'll be left with 40. That is the shares issue of shares. So of 40 were made. Issue of shares of 40 were made during the year. Then you are going to include that as financing activity. We have issue of shares. That is issue of shares of 40. That is note 8. 40. Then after issue of shares, we have lease payment. Let's have that as note 9. Then that is lease payment. You are starting with the opening balance as usual. Opening balance of lease liability. That is lease liability. This opening balance is in two places. The one under current liability and the one under non-current liability. Then we have the fair value of assets acquired through lease. So lease assets which will be added. Then now how much is involved? The lease liability, current liability, lease liability, the opening balance under current is 3. How much is the opening balance of lease liability under non-current liability? Non-current liability, lease liability, the opening balance is 30. So we have 3 and 30. The lease liability 3 and 30. This one is 3. The current, 3, and this is 30. Then lease asset. You were told asset acquired through lease, and that is 28 million. New asset acquired under leases totaled 28 million. So lease asset, the fair value is 28 million. So if you sum it up, 3 plus 30 plus 28, and that will give us 3 plus 30 plus 28, then the total is 61. Then you now less the closing balances. You less the closing balances. Closing balances, that is of lease liability. Closing balances of lease liability, the one under current liability and the one under non-current liability. So the one under current liability, the closing balance is 5. Then the one under non-current liability, the closing balance is 49. So we want to consider that 5 and 49. So we have 5 and 49. When you remove that, 61 minus 5 minus 49, and that will give us 7. That is the lease payment. We are going to recognize the lease payment of 7. Remember, the lease payment is an outflow. Then we are also given dividends paid in the movement in reserve. Dividend paid. Dividends is given of 12. So we are going to recognize dividend paid of 12. In case that dividend is not given, I've told you that you have the opening balance of retained earnings. Dividend paid, that is 12. The opening balance of retained earnings plus profit for the year minus the closing balance of retained earnings. Then we are also given loans of 16 in the closing and 31 in the opening. That means the difference represents, since it reduces from 60 to 31, because 31 is the closing and 60 is the opening, it reduces from 60 to 31. That means certain amount has been repaid, which is the difference. So loans repaid. Loans repaid. Loans repaid. The difference between 60 and 31, which is 29. Repayment is an outflow. So after this, we have 40 minus 7 minus 12 minus 29. Then the difference is 8 negative. So that is net cash flows from financing activity. Net cash flows from financing activity, or decrease in cash. Financing activity, the difference is 8, negative. So you now take the total of your cash flows from operating, net cash flows from operating activity, which is 131, minus net cash flows from investing activities of 32, minus net cash flows from financing activities of 8. Then you'll be left with 91. That 91 is your net cash change, or net increase in cash and cash equivalent. Net cash change, or net increase in cash and cash equivalent. Then the next thing is to consider your cash and cash equivalent at the beginning of the period. Cash and cash equivalent at the beginning. At the beginning of the period. How much? Check your current assets and your current liabilities. So, under current assets, we have cash at bank. The opening is 3. Then we also have investment. Opening is 20. Opening 3 and 20. Remember on your note on investment, we were told that the current asset investment is an investment in 30-day government bonds. Since it is an investment in 30-day government bond, that means it meets the definition of cash equivalent. So we have 20 plus 3, or 3 plus 20. Then current liability, we also have bank overdraft. Bank overdraft of 8 in the opening. Bank overdraft, opening is 20. That means we have minus 23. So the 3 is your cash at bank. Under current assets, we have cash at bank of 3. Then we have investment in the opening of 20. We have bank overdraft under current liability of 20 again. So after this, then the balance will be 3. Then 3 plus 91, then you have 94. That is cash and cash equivalent at the end. Cash and cash equivalent at the end. Now let's analyze this. How we arrive at this 94. Cash and cash equivalent at the end. Analysis of cash and cash equivalent at the end. At the end of the period. And this comprises your cash at bank, cash at bank. Then we also have investment. Then we also have bank overdraft. So under current assets, the cash at bank at the end is 7. Investment at the end is 95. Cash at bank 7. Investment of 95. Now let's consider that cash at bank 7. Investment 95. Then under current liability, we have bank overdraft. The closing. Bank overdraft. The closing is 8. So we less the overdraft of 8. So 7 plus 95, that will give us 102. 102 minus 8, that will give us 94. That is how we arrive at, that is what make up the 94 we arrived at in our cash flows statement. That is what make up the 94 we have in our cash flows statement. That is the end of the solution to the question. Please subscribe so that you will always get notification each time I drop any video in the future. Thanks. So you should be expecting more from me from time to time.